Good afternoon. It's 2 o'clock and we will be getting our webinar started. My name is Andrew Berger. I'm the president and CEO of the Indiana Manufacturers Association, and I'm happy to welcome all those in attendance here on our webinar discussing the tax provisions of the One Big Beautiful Bill. I think you could accurately call this or otherwise call this the One Big Manufacturers Bill or Beautiful Manufacturers Bill, because the tax implications and the pro-growth policies that were passed by this Congress and then signed into law by President Trump are, they're unprecedented for federal policymaking. I mean, I've heard it from the National Association of Manufacturers team that worked on this legislation that this is the most pro-growth, pro-manufacturing tax policy to come out of Washington, D.C. in their careers. And because of this industry that we're all part of, and these are some national numbers I'll share with you. For every $1 spent in manufacturing, that's an extra $1.85 in the economy. For every one job in manufacturing, it's 3 to 4 jobs elsewhere in the economy. So what helps the manufacturing industry is good for the overall U.S. and Indiana's economy. And that's why the provisions in this bill that you're all going to learn much more about today from our panel are so transformative for the manufacturing industry, but I think for the pro-growth, private industry, free market economy that we're all, happy participants in here on this call. I want to thank Katzapper and Miller, longtime partners and friends of the IMA, for their willingness to share their expertise with everyone on the call today. The IMA and KSM have a fantastic working relationship, and I know that the panelists here today are gonna provide a wealth of knowledge and expertise to everybody on this call. Of course, if you have other questions, feel free to reach out to me as well at the IMA, and whether it's a tax questions, which I'll be happy to answer, or if there's any other policy questions, issues with state government, we at the IMA are happy to help our members. Before I turn it over to Jordan to start the official program, I just want to also point out that the IMA is going to be starting our statewide tour beginning next week in Indianapolis at Goodwill, but we'll be sitting out throughout the rest of the late summer and fall across the state. And if you want to look for events in your area, please go to our website. And then on October 1st is our next big event, which is our manufacturing luncheon. KSM is a proud sponsor of that event as well. That's where we'll come together in Indianapolis for our annual luncheon, recognize some great stuff in manufacturing, and pair it with a lot of Manufacturing Day, Manufacturing Week, and Manufacturing Month events across the state to promote this industry and share the best practices to help you all and your businesses succeed. With that, and much more to come from the IMA, I will now turn it over to Jordan Mayer to talk about the One Big Beautiful Bill and all the tax wins for U.S. manufacturers. Jordan and the KSM team, thank you. Appreciate it. All on the call, have a great day.
Thanks so much, Andrew. Appreciate it. Good afternoon, everyone, and welcome to today's webinar for the One Big Beautiful Bill. We have a lot ahead of us here. So this is the OBBB tax wins for U.S. manufacturers. I am Jordan Mayer. I'm a tax partner in KSM's Business Advisory Group, as well as a partner in the firm's Manufacturing Distribution Services Group. Before we dive into everything and all of the beautiful details of this legislation, see what I did there, I do have a few housekeeping notes to get through. First, this webinar is going to be recorded. Both the recording and a copy of the slides will be available, and they will be emailed out to everyone tomorrow. Secondly, because we have so much information to cover today in a relatively short amount of time, we're not going to be doing any live questions. As questions, if they pop up to you throughout the presentation, just feel free to write them down. You can follow up with any of your primary KSM contacts or with any of the speakers today. We'd be happy to help. Today, you're going to be hearing from myself, Tim Mosier, Ryan Miller, and Stephen Royster on various aspects of the bill. This presentation is going to qualify for CPE. So we use the Conference IO platform to track attendance during these webinars. If you need CPE, please log in now using the QR code shown on the screen. You can also navigate to the Conference IO web address listed in the first bullet point here, and then choose the current OBBB webinar session. You can access the Conference IO platform on your phone or your computer. Once you're in the session, you'll first click the check in, and then you'll enter the code words. It's a bit of a misnomer to call them code words, as they're really just a random set of numbers. But when you get to that section, just drop in those numbers. You must attend the webinar for at least 50 minutes and enter at least 3 of the 4 code words or numbers to receive full credit. Please remember at the end of the presentation to check out when the presentation is over, and then your CPA certificate will be emailed from our learning management system in the next few weeks. So with that, we actually have our first code number already, and that is 491. Give you a couple seconds here to get that entered. If you're not logged in yet to Conference IO, just write that down and input once you get logged in. I'm sure more than a few of you are here just for the CPE, so make sure you get that number written down and entered when you can. Again, that is 491. Now on to the presentation. So here's a very quick glance at what we're going to be covering today. The OBBB, or OB3, as I've started calling it because it helps avoid me sounding like I have a stutter, is a large piece of tax reform legislation. It has over 100 tax provisions. So we've done our best to just pick the heavy hitters here that we think are going to be most likely to the members of the IMA. This is another good time to stress that if you have any questions or specific scenarios that you'd like to work through, please feel free to reach out to any of the presenters today or your KSM reps, and we'd be happy to help talk through any issues you have. We do have a lot to get through though, so I'm going to jump straight into our first topic, which is qualified business income. So as many of you may know, QBI is an extremely important 20% deduction regime for pass-through entity structures. This deduction was scheduled to expire after 2025, which would have been dramatic and had a huge impact on the taxation of those flow-through structures. Instead, thanks to OB3, we have this 20% QBI deduction as permanently being extended. The permanent language there is always funny to me as a tax accountant, as I don't trust any tax law to be permanent. But for now, let's just be positive and we'll act like permanent really does mean forever. In addition to making this permanent, there's also been some slight increases to the phase-in for income limitations, as well as adding in a minimum $400 deduction for taxpayers with at least 1,000 of active trade or business income. For these changes to these income phase-ins, as well as the minimum deductions, they are applicable for tax years starting after 2025. So business as usual for the 2025 tax year, and those changes take place in 2026. Next, we are going to keep the good news coming with bonus depreciation. So for bonus depreciation, we were in the middle of a multi-year phase down of bonus over the last few years, which was limiting bonus deductions by 20% each year, and bonus was set to be entirely gone after tax year 2026. So I'm sure many of you were impacted by these phase downs as you were working through CapEx projects with your internal finance teams and your accountants. And thankfully, thanks to OB3, we have reinstated 100% bonus starting after January 19th of this year. One important thing to caveat here is that in instances where you have a binding contract to purchase equipment, you have to look at the contract date instead of when the equipment arrives or is placed in service, or if you can take this 100% bonus. Just want to make sure we note that, as the bonus 100% bonus is back, but it's not necessarily going to be applied to every piece of equipment that is placed in service during the 2025 year. Continuing on to more good news, we have the changes to Section 179. So in addition to bonus, OB3 has also expanded the 179 expensing. We have an increase of total expensing from 1 million to 2.5 million. And there's also an increase to the phase out from 2.5 million up to 4 million. These increases to Section 179 are applicable for tax years beginning after 12/31/2024. So for any calendar year taxpayers, this would be applicable to all of 2025. So that is it for me real quick here, and we're going to hand things over to Tim Mosier to step into Section 174A. Go ahead, Tim.
All right, thanks, Jordan. So as Jordan said, we're going to jump into Section 174. For those who are not familiar with Section 174, that is the code section that governs the treatment of research and development expenses. So this has been a big topic for manufacturers over the last several years, because beginning in 2022, the law changed so that we had to capitalize and amortize domestic and foreign research expenses. We were amortizing the domestic expenses over 5 years and the foreign expenses over 15 years. Notably, a lot of things that you might not necessarily think of as R&D meet the tax definition of R&D. So this was really having a large impact on manufacturers. We had several kind of false starts where we thought we were going to see a bill passed to fix this, and none of those panned out. But thankfully, the OBBB gave us a pretty good fix. So we'll walk through what the new law says. So the new law says beginning in 2025, you can deduct your domestic research expenses. And then, you would still have unamortized research expenses for 22, 23, and 24. The new law gives you an opportunity to accelerate those deductions, and there's some flexibility in how you do that. We'll get into that point more here in a couple slides. And then for small business taxpayers, there was also the flexibility to make an election to go back and amend your tax returns to deduct those expenses rather than taking those deductions in 2025 or beyond. So overall, this is a huge win for manufacturers. This was something that was giving a lot of people, a lot of heartburn, creating cash flow constraints. So big win. And then on the next few slides, we're going to talk about some more of the nuances and some of the things about, how this gets applied. And there's a lot of stuff to think about. Don't let the details and some of the unknown questions cloud the good news here. This is a really big win for manufacturing. So in 2025, as I stated on the previous slide, we have the fix for domestic expenses. Going forward, you will be able to return to deducting those. I do want to highlight, though, that foreign research expenses are still required to be capitalized and amortized over 15 years. You may notice that on the slides, there's reference to 174 and then 174A. Historically, the code section has been 174. They created a new code section, 174A, to deal with domestic expenses. So we're kind of talking about the same thing there. There's just some tax nuances, but don't get caught up on that. And then something probably most taxpayers won't take advantage of, but there's still an option to capitalize and amortize your research expenses, the domestic ones, that is. So again, most taxpayers aren't going to go that route, but it gives some flexibility and can create some opportunities for creative tax planning. So great news for 2025. We're going to jump forward and talk about what do we do with the unamortized expenses. And there's really 3 options. So number 1 would be you could just deduct the remaining amount in 2025. There's also an option to split deduction between 25 and 26. And then you could also just continue to amortize the assets over the remaining life. I think the key thing here is just to think about, like a lot of times when we talk deductions, for tax purposes, more the better. And as we'll take them as early and as much as we can. But for a variety of reasons, that may not always make sense. Like there's going to be a lot of scenarios where it would be better off to take it over 2 years, or maybe even to continue amortizing it. we're going to talk through in more details in a couple slides, some of the considerations, and then also we'll try to put some numbers to a very simple example to try to illustrate this further. All right, so I do want to talk about small business taxpayers for a second before we move on. So we are talking about the election to go back and amend your tax returns for 22, 23, 24, rather than deduct the unamortized amount in 2025 or beyond. This applies only to eligible taxpayers, and to be eligible, you cannot be a tax shelter. That's a pretty nuanced definition. That's kind of beyond the scope of here, but that could potentially be a problem if you're allocating losses to passive investors. That'd be the primary area that we see it. And then the second requirement is that you must have less than $31 million of gross receipts based upon your prior 3-year average. So this would be 22, 23, 24. And notably, it does consider entities under common control. So if you owned, two manufacturing businesses 100% in separate entities, you would have to combine the receipts from the two to make the determination of whether you're an eligible taxpayer. So for the companies that meet the criteria, it could be a really good opportunity. In some instances, you may be eligible, but it won't make sense for a variety of reasons. So it'll be a very case by case kind of analysis on whether you'd want to take advantage of this or not. So how do I apply these rules? What are some of the things that we should be thinking about? You'd want to think about ownership changes, upcoming ownership changes if you're a flow through entity, when the deduction gets taken, how that gets allocated. You'd want to think through that. You want to look at your tax rate by year. If you're a C Corp, there's a flat 21% tax rate, but for our flow through entities, your marginal tax bracket could be different every year. So picking up a deduction in 1 year versus the next could make a meaningful difference. You'd want to think through 163J. We'll talk about 163J more in a minute, but this deduction is based upon your income. So if you have a big deduction related to these expenses, that could impact how much interest you can deduct. Whether or not you're going to create net operating losses. So net operating losses are limited to 80% of your taxable income. So it might not be beneficial to create a big NOL. And, really all of this is going to hinge on your future forecast and kind of where you predict income will be in the coming years. So, a reminder, like I said, a lot of things to think through here. Don't get overwhelmed though. If you have to make these decisions, it's, a good problem to have. So a quick example here, I tried to keep the facts real simple. We're assuming you have $1 million of income before we factor in interest expense and these unamortized costs. So we compare the 1 year deduction where it wipes out income in year 1, and then you have more income in year 2, compared to what if I took that deduction over 2 years? Because I took it over 2 years, I get some of my income in each year taxed at a lower marginal rate. So in this scenario, taking it over 2 years actually produced a better result than in 1 year. And then, of course, there's time value of money considerations. So I think the key thing is just, really putting numbers to it and making sure that, you've kind of modeled this out. So if you're a small business taxpayer and you're looking at whether or not you would want to amend or not, you would want to consider all those factors that we just talked about, plus a few more. So some things unique to the decision about whether to amend or not is you've got to look at the practicality of filing amended returns. If you have 50 shareholders, it's probably not going to be very practical. If you file in a ton of states, it might be harder to implement. And then we've got, this huge question of, how long is it going to take to get a refund? So definitely some things to think about there from a practicality standpoint. I would note though that, um, generally when you make a refund claim, you're going to get interest on the refund. So depending on how big the refund is, that, could be an important factor. And then lastly, um, we'll talk about this in more detail in a few slides, but there was a change related to the R&D credit that could also influence your decision on whether to amend or not. And we'll better explain that here in a few slides. Okay, so I threw a lot out. There's a lot of things to consider. What do we do right now? I think the important thing is to really try to model this out, work with, either for you to do it or work with your CPA to figure out, what are my options? What does it look like if I, take the deduction in year one or spread it? I think a lot of times, the tax returns becoming such a moving target with how deductions can impact each other, like the 163J, for example. So you really got to put pencil to paper and get some numbers down so you're not surprised. And then based on that, it's time to start looking at estimated tax payments. So we had a client we were just talking to where they had a huge unamortized amount of expenses. It didn't make sense to amend. They were a small taxpayer. And, we pretty quickly realized like, hey, it makes sense to take this in 25. And because you're going to have this big deduction, you probably don't need to make, any Q3 payments. So, depending on your amount of unamortized expenses, you might get kind of a good surprise when you go to do your Q3 estimates. The other thing I wanted to mention is that, if you're organized as a C corporation, there is the ability to request a refund of your overpaid estimated taxes after year end. What's unique about this is that the IRS is required to act within 45 days, and you can file it right after you finish your tax year. So this could potentially allow you to see a refund much faster than if you just waited to when you file your tax return. All right. One of the questions I always get when we talk about Section 174 and changes and what's going on is how does this impact the R&D credit? It largely doesn't impact the R&D credit. There's no changes to what qualifies. There's no changes in how you perform the calculation. There is one change though to what we call 280C. And 280C basically kind of refers to this idea that if I'm going to use expenses towards a tax credit and get the benefit of a tax credit, I shouldn't necessarily also get a deduction for those expenses. So historically, you had really two options. You could claim the full credit and reduce your research expenses by the credit, or you could claim the net credit and tax affect the credit. So if you were a C Corp and this was all being done at a 21% rate, usually it wouldn't really make a difference. We would generally just do the net credit so it didn't impact state taxes, and it was generally kind of easier. During the period of time, so 22 to 24, when we had to capitalize research expenses, the rules changed so that in a lot of cases you could actually take the full credit and not change your expenses. So it made the credit a little bit more valuable. The rule was basically changed to go back more in line with the historical rules where you had one or two of these options. So one of the requirements, if you were to amend under that small taxpayer election, is that you would have to, on the amended return, apply the old rules. So it could actually reduce your credit a little bit. You're still going to come out way ahead from the deduction for your expenses, but that is one more factor to consider in that analysis. So a lot of detail on this slide. Again, to recap it, the R&D credit's largely unaffected. There is this slight change to 280C that might make the credit just a hair less valuable, but other than that, no major changes. Things continue as they have. All right. So before we move on to a new topic, we've got our second code word here. That's code word number 2, and the number is 148. Again, code word number 2, 148. So the next topic we're going to talk about is section 163J. And section 163J controls business interest expense deductions. So ever since TCJA, we've had 163J, and it's basically, I'm going to simplify the limitation here a little bit, but it's basically the deduction is limited to a percentage of your ATI. And when TCJA initially came out, the ATI was based upon EBITDA. So from 2018 to 2021, we were basing the calculation on EBITDA. And then in 22, and then for the last couple of years, the definition changed to EBIT. So for manufacturers, this was a pretty significant change because we tend to have a lot of depreciation. So during 22, 24, we saw a lot of manufacturers that struggled with having these large disallowed interest expense deductions that get carried forward. So what OBBB does for us is it changes the definition permanently, as much as anything in the tax world can be permanently, to EBITDA. So going forward in 2025, this hopefully helps their manufacturers have less of a challenge here. All right. The next topic we're going to hit on is qualified production property, QPP. This is a unique one in that a lot of the provisions of the bill related to extending or reinstating certain rules. QPP is something that's really unique or new. We haven't seen this before, and in the news you'd hear this kind of referred to as the bonus depreciation for manufacturing facilities. So the bill allows an election for 100% bonus depreciation for qualified production property. We're going to walk through what that really means on the next coming slides. I want to highlight though that there's a couple of dates that you want to pay attention to. So this applies to items placed in service after July 4th and before 2031. And the construction date has to begin after January 19th and before January 1st, 2029. So key dates there, you got to watch. And then similar to what Jordan mentioned on the traditional bonus depreciation, we do have to look at written binding contract dates. So that'll be key as a part of this analysis. What is qualified production property? So we're looking for non-residential real property that's used as an integral part for qualified production activity. We'll dive more into that in the coming slides. It has to be placed in service in the US. The original use has to begin with the taxpayer. So if you purchase an existing manufacturing facility, that doesn't qualify. If you purchase a building that hasn't been used for production since I think it's roughly the last 5 years, then that could potentially qualify. And then lastly, you got to make an election on the tax return for this to apply. So before we jump more into what is qualified, I do want to highlight a couple things that don't qualify. So the law very specifically carves out offices, administrative services, some things that they feel are not directly related to the production activities. So, if you have a big facility that you're building, or maybe you purchase a property that wasn't used for manufacturing, there may need to be some carve out of, okay, here's the costs associated with the eligible space, here's, the non-eligible space. It'll be really interesting to see what guidance we get on this. One of the big things that kind of glares to me is that they don't have any discussion of warehouses. I think that'll be an area where we're going to need some guidance, and it might be complicated because where you store goods is not always clearly segregated from production activities. So that's going to be one area that I think will be interesting to see where they land. Another important one is to note that you have to own the property. Property depreciated by a lessor does not qualify. And what we see in the bill doesn't, provide any carve out for self rentals. So traditionally, we've advised our clients in most cases have the real estate and the operations separately. Absent some guidance from the IRS, saying that there's an exception for self rentals, we're going to have to look at that and say, okay, in light of the benefit of this deduction, does it make sense to put the real estate in the operating entity? So that'll be interesting. So what are qualified production activities, now that we've kind of hit on what a few things that don't qualify? So we're looking for the manufacturing, production, or refining of a qualified product, and there has to be substantial transformation. Again, I think this is going to be a very interesting area to see how they define substantial. I think for a lot of our clients, it might be relatively clear cut whether or not they qualify. But if you're like a real light assembly type of facility, like where does that that line get drawn? So that's an area where we expect we'll need some guidance to figure out just where the line is. So with that, I'm going to turn it over to Ryan Miller.
Great, thank you, Tim. So now we're going to talk about no tax on overtime and no tax on tips. We've all heard a lot of that, but of course, describing these provisions in this way is misleading. A more accurate description is there are new individual deductions for some overtime and some tips. And while these provisions do not provide any direct tax benefit to the employers, there is an impact on payroll reporting that's worth mentioning. So the two provisions have a lot of similarities. So this slide applies to both the deduction for overtime and the deduction for tips. So these are employee level individual income tax deductions that will be claimed on individual 1040s. They're temporary, just through 2028. They can be claimed without itemizing. They're subject to income phase outs, and married taxpayers must file a joint return. So from an employer perspective, the overtime pay and tips are included in the employee's taxable W-2 income, the same as they always have been, and they are subject to all the payroll tax withholdings, including subject to Social Security withholding. So these amounts are not exempt from income tax, and they are not exempt from payroll withholding taxes. But where this does impact the employer is that the employers will need to track qualified overtime paid and qualified tips that are included in the W-2s, so the qualified amounts can be separately reported on the W-2s. Now, this can also apply to independent contractor situations and the related 1099 reporting, but we're focused on W-2 reporting here. So one word of caution is to make sure your payroll folks have a plan for capturing these amounts. It's going to be difficult to do timely if you wait until the end of the year to try to figure this out. However, in the short term, some guidance may be needed with respect to 2025. It is possible the service will provide methods to estimate the 2025 amounts, given that we were halfway through the year before the law passed. But we'll see what guidance we get, if any. Can't really count on it. And there may also be guidance to allow modified withholding procedures to reduce income tax withholding to take these deductions into account. But I don't believe withholding procedures can be changed unless specific guidance is issued. And the modified withholding procedures may not apply until 2026. So again, depends on the guidance that we receive. This slide has a little information that is specific to the overtime deduction. The maximum deduction is $12,500 or $25,000 if it's a joint return. You can see the deduction phases out when modified AGI exceeds certain thresholds. But most important to this audience is likely the definition of qualified overtime. And qualified overtime is overtime that is required to be paid by Section 7 of the Fair Labor Standards Act. So overtime pay that FLSA does not require is not qualified overtime for this purpose. So if the overtime is paid pursuant to a labor union agreement or a specific state law requirement, but it wasn't otherwise required by the federal law, it may not qualify as deductible overtime for this purpose. So something to parse out there. And only the amount in excess of the individual's regular rate constitutes qualified overtime that could potentially be deductible. So the example here is an employee that is making $20 per hour. They work one overtime hour at $30. The qualified overtime is $10. That extra time and a half component, the qualified overtime is $10. It is not the full $30 the employee was paid for that one overtime hour. So again, the employer in this example will need to report on the W-2 that $10 of their total compensation is qualified overtime pay. So again, there's a reporting burden here. This slide has a little information unique to the tips deduction. I'm just quickly going to note that qualified tip income is limited to tips from occupations that customarily and regularly receive tips prior to 2025. The service is tasked with providing a list of qualified occupations by October 2nd, so we're waiting on that list to be issued. But I assume this audience deals with overtime on a pretty regular basis, but probably not tips so much. Okay, we've got code word number 3. So before we move on, code word number 3 is 443. Give you just a minute. Code word number 3. Going once. 443. Okay, that is all we have on overtime and tips. So our primary message there was a caution to make sure payroll folks have the new reporting obligation on their radars and are developing plans to track it. Now, as quick as we went through overtime and tips, we're going to go even quicker through the international tax changes. There will be more content on the following international slides than we can cover, but the slides will be available to you for reference, once you receive them. There are a couple nuanced provisions effective now, but for the most part, you'll notice these international provisions are effective after 2025. So there is a little time to plan if you are impacted. The first provision we have is modifications to the GILTI regime. GILTI applies if you have a controlled foreign corporation in your structure. And first, they changed the name, so it's officially net CFC tested income now, but we're still referred to it as GILTI for now. And maybe the biggest takeaway for those of you dealing with GILTI inclusions, they eliminated the deduction for 10% of QBAI. So this will function to increase GILTI inclusion amounts for capital intensive CFCs. They offset this a little with favorable changes to the foreign tax credit regime. So a higher GILTI inclusion due to elimination of the QBAI deduction, but potential for a larger foreign tax credit. And we'll see case by case how it shakes out. The next concept is the FDII deduction available to US C corporations that have export sales. You'll see on the slide that they changed the name of this one too, but again, we're sticking with FDII for now. And again, they eliminated the haircut for 10% of QBAI. But in this instance, this will function to increase the FDII deduction. So this is a taxpayer favorable change with respect to FDII deductions, whereas the QBAI issue is taxpayer unfavorable with respect to GILTI inclusions. For anyone out there with tiered CFCs in your structure, they finally made the look-through rule permanent with respect to personal holding company income that is coming up through the tiers. And this downward attribution issue is a huge deal for anyone impacted. This is a very technical and very difficult issue to explain in a quick, concise manner. And there's a good chance none of you are impacted by it. But if you have been impacted by the concept of downward attribution, if you know what that is, then note that there is relief coming in 2026. There's an important change in who picks up CFC inclusion income when there are ownership changes during the year. The inclusions will now go pro rata to everyone that owns shares of the CFC during the year. The first bullet point on this slide is interesting. They changed the sourcing rule for US manufactured goods that are sold through a foreign branch. If the sourcing rules otherwise treat the income as US source, the new rule can treat 50% of the income as foreign source for foreign tax credit purposes. So this is potentially favorable to the extent it allows for a larger foreign tax credit. The other concept on this slide is BEAT, which only applies to large corporations with average annual gross receipts in excess of $500 million. If you are a large corporation that is subject to BEAT, they lowered the 2026 tax rate from 12% to 10.5%, and they made a favorable change to the ordering rules for taking R&D tax credits into account. This final international slide is a couple provisions that did not get into the final legislation. So these items did not become law, but they got a lot of press during early drafts. Most notably, the dreaded revenge tax got pulled from the final legislation. So there is no Section 899 revenge tax. Thank goodness for that. And that concludes the lightning fast international summary. If none of that made any sense to you, then good for you. It probably doesn't apply. If all of that made perfect sense to you, I feel for you. I know what you're going through. But we're going to move on here to a final blast of miscellaneous topics that could be important to some of you. And the first up is maybe the most discussed topic among major media outlets, the SALT cap. This is the individual itemized deduction for state and local taxes. So for any flow-through structures out there, this may impact the owners. After much negotiation, they settled on a temporary increase of the SALT cap from $10,000 to $40,000, available for 2025 through 2029, with small inflation adjustments after 2025. But they also subjected the increase to an income phase out. So for anyone hoping to take advantage of the increased SALT cap, you do need to be mindful of the income phase out, which starts once modified AGI exceeds $500,000. And I note on this slide that there are no new limitations on PTET deductions, which was something that was in previous early drafts of the bill. So the value of PTET regimes continues on. And generally, we expect PTET to be more favorable than trying to rely on the increased SALT cap. Next is 1202 stock. So 1202 applies to certain stock issued by certain C corporations. The gain on disposition of qualified 1202 stock is excluded from income. So this is a very powerful and very valuable exclusion when it applies. In fact, 1202 is valuable enough that it can be the deciding factor that encourages a C corporation structure when planning the structure of a new investment or when thinking about converting to a C corporation. Under the right circumstances, of course. There are a lot of rules that require a lot of careful analysis, but you just want to make sure 1202 is at least considered in the structuring analysis. The new law expanded the 1202 regime with respect to C corporation stock issued after July 4th, so it may apply in more situations going forward. Obviously, 1202 will not make sense for everyone or even most. We still expect heavy utilization of flow-through structures, but proper analysis and consideration is important given the potential for such valuable benefits when the situation is right. The employee retention credit, we're almost done with this. The only thing I'm going to say here is for anyone that filed a refund claim for Q3 or Q4 of 2021, if you filed the claim after January 31st of 2024, the claim is going to be denied. So basically, the accelerated termination of the ERC for Q3 and Q4 of 2021. Finally, there were a lot of changes to energy credits, generally not favorable to the taxpayer. There are way too many energy credits to cover today. That would be a whole webinar of its own. But the important takeaway is if you are planning projects or you have any plans to utilize any energy credits, you do need to review your specific facts and the specific credits you plan to take advantage of, because most of the IRA, the Inflation Reduction Act era energy credits, are being terminated early. And for those that are not being terminated, there are tighter rules in place. So beware and double check with your advisors if you plan to utilize these energy credits. And that is all I have. I'm going to turn it over to Stephen Royster because we can never forget about the states.
Thanks, Ryan. That's a great coverage. And I guess just real quick, I'm Stephen Royster. I'm a partner in the state and local tax group. And I guess if the federal folks are worried about 100+ tax law changes, we have about 45 states that have some level of income tax. So we're dealing with maybe closer to 4,500 to 5,000 potential tax law changes across the country. So obviously there's a lot of moving parts. But I guess to start with, for our perspective here, forgive me, as the slides went black on me. Most states actually start with federal taxable income as our base. And so they incorporate the Internal Revenue Code as of a certain date. And in doing so, they incorporate the laws as of that date. And like many things from a state and local tax perspective, the states don't necessarily agree with when those laws should be incorporated. So we have a varying level of conformity year over year. And so when you talk about a law that was passed just at the beginning of July, there are some states that have something called rolling conformity. And so rolling conformity means as soon as a federal law changes, you will actually have it'll be incorporated into a state law. For example, like New York would have a rolling conformity. So right now, the OBBB is incorporated and is the law of the land in New York. Unlike Indiana, which an incorporation date of the Internal Revenue Code is January 1st of 23. So really, when we start to look at the kind of how the impact of the OBBB is from a state perspective, that IRC conformity date is a really big deal. And so helping, that's really kind of step one in understanding what we need to do from a state and local tax perspective to be thinking about the changes and the impact. There's also states that have what we would call static conformity. And static conformity, that'd be the Indianas, but then the hybrid conformity where they kind of pick and choose what they want from a federal tax perspective. So if we actually look at Indiana, because obviously we got a lot of Indiana companies represented on this call, Indiana has always had really taxpayer-friendly laws. So a lot of these changes may not really impact. So when we talk about 163J, Indiana decoupled from that immediately, allowing business interest expense. We look at when we look at the GILTI income, that was always decoupled from where you didn't have to pick up GILTI, and they allowed for the FDII deductions. The only real item on there that historically we haven't necessarily coupled with is bonus depreciation, and we don't anticipate Indiana changing that methodology now. So kind of the two bigger items is the new bonus depreciation, the 168N, and then the 174, the R&D or the amortization expense. Indiana had already, again, decoupled from bonus depreciation and was already allowing the amortization expense fully. So we really, Indiana is pretty straightforward. some might say that the federal government finally decided to agree a little bit with Indiana, because this is how we kind of been decoupling from the Internal Revenue Code up to this point. And so right now, since we couple to January 1st of 2023, none of the OBB really is impactful to our calculation of Indiana tax. See if I can get the slides to move on me. So when we're thinking about why do we care now? We care because of estimated tax payments. We care because there's some of these changes impact 2025 from a federal tax perspective. And if they impact 2025 and you're in a state that has a rolling conformity, then those changes are impacting whatever calculation potentially in that state. So when we're looking at Q3 estimates and Q4 estimates, understanding again that IRC conformity is the first thing we need to do from a state perspective. And then obviously it's going to roll into extension payments for 2025. I guess what can get lost in this a little bit is the legislative sessions of states, for the most part, are over. As we were looking, I think around 8 states still have their legislative session open so that they can make a retroactive change or make a change to incorporate some level of the OBBB. But if they don't, well then we're just kind of a little bit on pause. So this is a lot of words about state and local tax to basically say, hey, we're trying to figure out what's going to happen for the most part. Those rolling states are the ones that we anticipate hearing from first, because we think if they don't like something of the OBBB, then they're probably going to speak up first and foremost. And so I guess, again, not to get lost in 4,500 potential changes, but there are a lot of moving parts here. And really, states are doing the same thing we're doing. They're digesting what these changes were from a federal perspective to then know what do they need to do, what do they need to decouple from, what do they need to adjust. And with so many tax provisions, that there's just a lot of effort that's going into this. I do want to mention that the idea of any sort of amended returns from a federal perspective relative to any of the changes from the OBBB. When you amend a federal return, generally you have to amend a state return. In states that decouple from a lot of the federal changes, all of a sudden you might have this influx of deductions from a federal perspective. And in Indiana, you may actually have to have add backs because you've already deducted, say, the research and development cost. You've already deducted those in prior years. So now that's getting trued up from a federal perspective, you may actually have an add back. So as you're thinking through kind of your tax calculations over the next 9, 12, 18 months, you just got to be mindful of how the states are dealing with this and how they're looking at it. So it's a long way of saying, hey, stay tuned. You'll probably hear more from us with respect to state and local tax implications, because it is an ever-moving target. And with that, I think I have our last polling number. That is code word number 699. And Jordan, I think I'll turn it back to you.
Thanks, Stephen. That wraps up our webinar today. I really appreciate everyone joining. Obviously, again, feel free to reach out with any questions. Happy to follow up with more specifics. And if you signed in for CPE, make sure you check out of the platform. And that's all we've got. I appreciate everyone for coming. Thanks.